The world of options, a beginner's guide. Welcome to the exciting world of options trading. Options can seem complex at first, but once you understand the basics, they offer incredible opportunities for investors of all levels. In this guide, we'll break down the essentials of options trading. We'll discuss different strategies and how they can help you achieve your financial goals. Understanding options contracts with potential. Options are like contracts that give you the right, but not the obligation, to buy or sell an underlying asset. Think of it like buying a ticket to a concert. You have the right to attend, but you don't have to go if you change your mind. This underlying asset could be a stock, an index, or even a commodity. There are two main types of options: calls and puts. A call option gives you the right to buy the underlying asset at a specific price, while a put option gives you the right to sell. Covered calls generating income with limited risk. One of the most popular strategies for achieving this is through the use of covered calls. This method allows investors to generate additional income from their existing stock holdings while maintaining a relatively low level of risk. Let's say you own 100 shares of company XYZ, and it's currently trading at $50 per share. This is a common scenario for many investors who have a diversified portfolio and are looking for ways to enhance their returns. You're bullish on the stock long-term but wouldn't mind earning some extra income. This is a typical mindset for investors who believe in the potential of their holdings but also want to capitalize on short-term opportunities. This is where covered calls come in. By implementing this strategy, you can potentially increase your overall returns without having to sell your shares outright. By selling a covered call option, you give someone else the right to buy your 100 shares at a specific price, the strike price, within a certain time frame. This means you are essentially renting out your shares for a premium. In exchange, you receive a premium. This premium is the income you generate from the covered call strategy, and it can be a significant addition to your overall returns. For example, you sell a covered call with a strike price of $55, expiring in 1 month for a premium of $2 per share. This is a common scenario that many investors use to generate additional income. This means you receive $200, 100 shares times $2. This premium is yours to keep, regardless of what happens to the stock price. If the stock price stays below $55, you keep the premium and your shares. This is the ideal scenario for many investors, as they get to keep their shares and the premium. If it goes above $55, your shares might be called away, but you still get to sell them at a higher price. This means you benefit from the appreciation of the stock price, in addition to the premium you received. Covered calls are a versatile strategy that can be tailored to fit different investment goals and risk tolerances. Whether you're looking to generate additional income or hedge against potential losses, covered calls offer a flexible solution. By understanding and utilizing covered calls, you can enhance your investment strategy and achieve a balance between risk and reward. This approach allows you to make the most of your stock holdings while minimizing potential downsides. So, the next time you're looking to generate income with limited risk, consider the power of covered calls. It's a strategy that can help you achieve your financial goals while keeping your investments secure. Protective puts shielding your investments. In the volatile world of investing, safeguarding your assets is crucial. One effective strategy to achieve this is through the use of protective puts. Protective puts are like insurance for your portfolio. They provide a safety net, ensuring that even if the market takes a downturn, your investments are shielded from significant losses. Imagine you believe in company XYZ's long-term potential, but want to protect yourself from a potential market downturn. You are optimistic about the company's future but wary of short-term market volatility. Buying a protective put option gives you the right to sell your shares at a specific price, the strike price, within a certain time frame. This means that no matter how low the stock price might drop, you have the assurance of selling at the strike price. For example, you buy a protective put with a strike price of $45, expiring in 6 months, for a premium of $1 per share. This premium is the cost of your insurance. This costs you $100, 100 shares times $1. While this might seem like an additional expense, it is a small price to pay for the peace of mind it offers. If the stock price stays above $45, your put option expires worthless, but your losses are limited. you might think of the premium as a small sacrifice for the security it provides. If the price drops below $45, you can exercise your put option and sell your shares at the higher strike price, limiting your losses. This strategy ensures that you are not left vulnerable to drastic market declines, allowing you to invest with greater confidence. Straddles are an exciting strategy for when you expect a significant price move in an underlying asset, but you're not sure which direction it will go. This strategy is particularly useful in times of high market volatility, where price swings can be dramatic and unpredictable. By employing a straddle, traders can position themselves to benefit from these large price movements, regardless of whether the market trends upward or downward. It involves simultaneously buying both a call and a put option with the same strike price and expiration date. The call option gives you the right to buy the asset at the strike price, while the put option gives you the right to sell the asset at the same price. This dual approach ensures that you are covered no matter which direction the asset's price moves. For example, company ABC is expected to release its quarterly earnings report soon, and you anticipate a big move but are unsure if it will be positive or negative. Earnings reports often lead to significant price changes as they provide new information that can alter market perceptions and valuations. By setting up a straddle, you can take advantage of the anticipated volatility without having to predict the exact outcome of the earnings report. You decide to buy a straddle with a strike price of $100, expiring in 2 weeks. This means you purchase both a call option and a put option at the $100 strike price. The cost of setting up this straddle is the combined premium of both options, which you pay up front. The expiration date is crucial, as it determines the time frame within which the price movement must occur for the strategy to be profitable. If the stock price jumps to $110 or plummets to $90, your straddle profits because one of your options will significantly increase in value, offsetting the cost of both options. The key to a successful straddle is a substantial price movement in either direction. The more the price deviates from the strike price, the higher the potential profit. This strategy allows traders to capitalize on volatility and turn uncertainty into an opportunity for gain. Real-world examples: applying option strategies. Imagine you're an investor who believes in the long-term potential of electric vehicle company Tesla, or TSLA. You could use covered calls to generate income while holding onto your shares. Or, if you're worried about a potential market correction, protective puts could provide downside protection. For traders who thrive on volatility, a straddle on a company like GameStop, or GME, during a short squeeze could lead to substantial profits. Weighing the pros and cons, making informed decisions. Each option strategy has its own set of advantages and disadvantages. Covered calls offer limited profit potential but generate income and reduce the break-even point of your stock holdings. Protective puts act as insurance, limiting potential losses, but they come at a premium cost. Straddles offer unlimited profit potential if the underlying asset makes a significant move, but they can be risky if the price stays within a narrow range. Choosing the right path. Finding your option strategy. The best option strategy for you depends on your individual investment goals, risk tolerance, and market outlook. Are you looking to generate income, protect your assets, or capitalize on volatility? Understanding your objectives is crucial when navigating the world of options trading. The power of options. Mastering your financial future. Options trading offers a flexible and potentially lucrative way to participate in the financial markets. By understanding the different strategies, assessing the risks and rewards, and aligning your choices with your investment goals, you can leverage the power of options to master your financial future. Remember, knowledge is power, and with the right information and guidance, you can navigate the exciting world of options trading with confidence.